Hello and welcome everyone. My name is Cameron May and I want to welcome you to our 1-hour discussion relating to our investor conference discussion, our using fundamental analysis to invest in value stocks. I'm looking very much forward to it. This is a topic that strikes near and dear to my heart because I love getting a bargain. And I'll tell you right up front what we're going to be discussing. I want to start with a story. Those of you who have participated in the markets going back to 2000 and 2009, I want to give you this sort of ugly history lesson. You know what happened in 2000 when that dot-com bubble burst. We know what happened in 2007 when we had retracement from the financial markets and the real estate industry really got hit. Well, those times a lot of stocks took a severe cut in their share value, but there were so many they got down to bargain basement levels. How do we recognize potential? How do we recognize value? How do we recognize the bargains when they're right there in front of us? That's today's discussion. So I think it'll be time very well spent. Let's first knock out our disclosures, make sure that you are comfortable with the risks associated with the investing. The following presentation is for educational purposes only and is not a recommendation or endorsement of any particular investment or investment strategy. Neither InvestTools nor its coaches are financial advisors. We are not a broker-dealer, so we don't provide financial advice or investment recommendations. Paper money success is not a guarantee that you're going to have success with your real funds. Investing plans and rules are provided for informational purposes only. Trading securities can involve risks, so you need to be aware of those risks before you attempt to trade. Okay, finally, third-party content is provided for informational and or entertainment purposes only. InvestTools and TD Ameritrade are separate but affiliated companies, and please no soliciting or photography. All right, so let me get you acquainted with your instructor. So I've been an InvestTools coach here since 2005. As I mentioned, my name is Cameron May. Believe it or not, even stretching back more than 12 years, that still only makes me about average as far as seniority here at InvestTools is concerned. We love what we do. We love bringing it to you. Before I came to InvestTools, I spent about 8 years on Wall Street. I was a broker in Las Vegas where I ran an office for one of the big firms. I then moved here to Salt Lake City where I spent time as a margin analyst and as a risk analyst, and I was also a trader on an options trade desk, and that's when InvestTools headhunted me. So that was May of 2005. I've been a presenter here ever since. I've had some really interesting experiences along the way. I've taught thousands, maybe tens of thousands of self-directed investors. But just recently, I returned from the 2017 NFL Personal Finance Camp. That was a repeat appearance. I went there also in 2016. There in Fort Lauderdale. Great way to spend some time just hanging out with some players on a beach in Florida. So my hand's up the next time anybody needs me to do that sort of thing. All right, I do emphasize, as you'll notice in that fourth bullet point, the importance of risk management and balanced investing, and what we're going to be discussing today could play a role for a portion of your investing. It's entirely up to you, but it is something that I have a great enthusiasm for. Finally, my hobbies. My wife and my kids and I like to pile in a car and go out and do stuff. We like to go out kayaking. We like to go hiking. We like to just travel. So when a day opens up, we pile in. Sometimes we don't know the destination, we just take off. But today, we definitely have a destination in mind, okay? Today, we want to learn how to understand, we want to learn how to value stocks. We want to understand how value opportunities can also swing back and forth between different industries. We want to identify the characteristics of value stocks. We want to estimate what we call a stock's intrinsic value using a spreadsheet that really you can only get here from this course. So pay close attention. You're in sort of an exclusive group having attended this class. This spreadsheet is only available to you as attendees of this investor conference breakout session. But let's just get right straight into it. I have a question for you. What do you see? Take a look at this picture. Yeah, a bunch of rusty, old junk cars, right? That's probably what we see with our untrained eyes. The average Joe probably looks at this and they say, well, okay, so I see a lot of weeds. I see a whole lot of rust. I see maybe right here a broken headlight. I see some missing windows. I just see headache. Now, what does an expert in classic car restoration maybe see? I think they see this through an entirely different lens. What they're probably seeing is, boy, classic cars. I'm seeing potential. I'm seeing profits where everyone else sees a junkyard. Right? What we need to do today is train our eyes to see the markets in the same way that these car experts see restoration opportunities. When you see something getting beaten up in the markets, how often does that represent real opportunity? But how often do we miss that opportunity because we just didn't have the training to teach us what we were witnessing? Okay, so there's going to be a bit of a different mindset as we get deeper into this discussion. Because here at InvestTools, very frequently we talk about trading with the trend. In my discussion, I'm going to be talking about going where others aren't, buying things that are unpopular, digging through the beaten up stocks, because if you think back on 2000, you think back on 2007, you know that stocks got really beaten up. A lot of companies deserve to get beaten up. Maybe some of these junk cars deserve to be junk, but there might be others that really have that hidden opportunity if seen through that expert eye. All right? So we need to train ourselves to see the markets in that same way. Great quote here from Joel Greenblatt. The secret to investing is to figure out the value of something and then pay a lot less. I don't know if you know who Joel Greenblatt is. He's a Columbia University business professor. He's also a value investor. If you were to go look up his bio online, a lot of what we're going to be doing today is going to sound familiar by the end. So if you look up his bio after we're done, you'll start to be able to draw those parallels. But he managed a fund called Gotham Capital. Gotham Capital had a value investing approach and really outperformed the market over decades. So when investors like that speak up and they start talking about value, my ears perk up, I'm ready to listen, and I hope that you do too. Okay, but first what we need to do is let's train our brains to think in a contrarian manner. Okay, where do we look for value? Class, it's always easy to go with the crowd, right? Just look at that beach scene, very popular. I'm sure it's beautiful. But I'll tell you what, my nature, I look at that and my shoulders start to shrug up and I get a little bit tense because I don't like those kind of places. I do for a little while. They're kind of fun. But I don't want to spend too much time there. And if I'm looking for something of extraordinary potential, I'm probably not going to find it where the crowd already is. So as I'm describing this, think about what's going on with the markets right now. Where are the crowds? What are the popular industries and the popular sectors? And whatever those are, that's not where we're going to spend our time. We want to instead find the abandoned areas of the marketplace. We have to go where no one else is, and I'll tell you what, at the time you do it, it's going to feel wrong. If you describe what you're doing to other investors, they'll probably think you're crazy because you're going to be buying stuff that the talking heads are saying on TV are saying, oh, this industry is terrible, that sector is awful, maybe their trends on their stock prices are down, their products are unpopular at the moment, it's the wrong season, it's all of those things that are going to make you feel like you're doing something wrong, like you're not in the in crowd, but you're doing the right thing. If you're feeling like that, you're looking in the right place. On the other hand, if the stocks that you're looking at, if the industries that you're examining are getting lots of publicity currently through the talking heads, if there are lots of headlines proclaiming their greatness in the magazines, If your neighbors and your friends are talking about having purchased the same thing recently, you're probably in the wrong spot, right? All right, so let's get into figuring out where to find these kinds of companies. I have one example. It's not the only example. But one thing that you can do as you look for unpopular stocks in out-of-favor sectors or out-of-favor industries is you can learn about consumer cyclical versus consumer non-cyclical companies, also known as staples and cyclicals. All right? We're going to talk about these because what you'll notice is that in these two competing sectors of the marketplace, one of them tends to be popular at any given time, and the other one doesn't. It'll be out of favor. So what our instincts tell us to do is that when the one's popular, then we want to throw our money at it. But for this class and this discussion, I want you to find out what's popular and then dig into the other one for potential. So we have to be able to understand how to tell them apart first. So how do we tell these apart? First, we'll start with what we call consumer staples. You've probably heard the word staples before. I'm not talking about the thing that'll hold your pieces of paper together on your desk. Instead, I'm talking about the staples of life. Okay, consumer staples are things like your utilities, your gas company and your electric company, healthcare, and other things that you just can't live life without. Okay, those are the staples. So when you're trying to make a determination whether a company might fall into a staples versus a cyclical category, think about it. Is this something that I could do without for a long period of time? I can't do without electricity. I can't do without water. I can't do without health care. I can't do without my household products. You know what I'm referring to. Even things like soft drinks, for some people, tobacco, food. Okay, those are the staples of life. Those are the staples of Wall Street. All right. So what are the characteristics of these kinds of companies? That's a broad discussion of what they are. But what are the hallmarks of non-cyclical companies or staples? Number one, the products and business lines are in more or less continuous demand. You know, we don't stop going to the doctor just because maybe the household budget is getting a little bit tight or because the economy is struggling a little bit. There's a consistent demand for these products. Okay, number two, profitability of the companies is less dependent on the strength of the overall economy. It tends to be very consistent because the demand is consistent. So profitability stable, the company benefits from that. That bleeds over into their sales and their earnings. Now, stable might sound very attractive to some of you who are listening in right now. To others, though, you think stable is boring, right? Last thing I want to do is buy a stock for $50 and it stays worth $50 over the course of a year. That is the definition of stability. It also is the definition of frustration. And companies with extremely stable, predictable sales and earnings can have difficulty attracting investors. So they will dangle a carrot. So one of the other hallmarks of these sorts of companies is that they often pay dividends. So why do they pay dividends? Because maybe investors are aware that their products are in consistent demand and their sales aren't going to do anything explosive over the next 12 months. They haven't done anything explosive over the last 12 months, so why should things change? So we need some other thing, something else to attract investors. That is dividend. So just remember those hallmarks as you're looking at a company. And if you can't remember all the hallmarks, just think, is it something that I can do without? If it's not, it's probably a staple. Okay, so what is a cyclical company? A cyclical or consumer discretionary companies, very broadly stated, are things like restaurants and furniture and clothes. And you might think of clothes as, oh, I've got to have that. Well, yeah, you already have some clothes. The point is spending on new clothes tends to be cyclical. Broadcasting, how many of you have cut the cord on your, or maybe your neighbors have, on your cable bill because you just didn't want to pay it anymore? Maybe, you know, you had to find some room in that budget. It's those sorts of things. When the budget gets tight, where do you start to trim first? And that is the definition of a consumer discretionary kind of a company. Home building, autos, casinos, hotels, cruise lines, the extravagances and the luxuries of life. All right, so you might think, oh, those sound terrible, right? If everybody's cutting them out, how can their stock shares ever grow? Don't get ahead of yourself there. The consumer discretionary industry is actually doing very well right now. As the economy goes, so tends to go consumer discretionary. Okay, so how do we recognize them? If we're not entirely sure, if we don't remember that list of all of those different types of companies that I just gave you, well, their products or business lines tend to fluctuate in demand. We already know that. Their profitability is more or less dependent on the strength of the overall economy. Their earnings and sales are less stable. Now remember, stable doesn't mean good necessarily. You can have a lack of stability because we're growing so explosively. They also tend to not pay dividends. They prefer to retain those earnings rather than sending out a check to all their shareholders. They'd rather retain those earnings and invest that in new growth opportunities, opening a new restaurant, opening a new sales floor, opening a new retail outlet. All right. So we want to know the difference between these two because when staples fall out of favor, discretionary tends to rise to the front and vice versa. So we want to recognize the ones that are out of favor and look there for value. And in almost all market conditions, you can find value. It gets harder and harder at certain times. For example, when all the markets are touching all-time highs as they are as of the moment of this recording, but maybe by the time you read this, there might be a lot more value opportunities out there. Although I still had little trouble going out and finding good value with a little bit of digging. All right. So as we dig in, we want to start thinking like that restoration expert. We're going to be looking, we're going to be beginning with the end in mind. All right. So we need to train our brains to look for those companies that are out of favor. But I'll tell you what, in order to think like an expert, we have to be prepared like an expert. What are the sorts of questions that an expert asks themselves and the sorts of things that they know about those vehicles before they make that initial investment? Well, they have a checklist. They know the make and the model they're in demand. They know the type of shape it needs to be in. They know the rough costs for restoration. They know the market for a finished product. So they've done a lot of legwork. They have a checklist. We need a checklist. We need to know specifically what a value stock looks like. Now that we've identified maybe a sector, maybe an industry that's fallen out of favor, it might be restaurants, it might be real estate, it might, all of these things go through cycles. So I'm going to prepare us with a checklist. All right, so let's get that checklist together. It's going to save us a ton of time. If you know what a value stock looks like and you can do a quick screen, if you find a stock and you think, oh, I wonder if this is if it's a good deal right now. If you have a checklist, you can check it off very quickly. So what are the characteristics of value stocks? Well, there are some things that are just the hint that you're onto something of some value. And these can be checked in a glance. That's why we have this list. Now, there's a bit of a process that goes well beyond this checklist that you'll learn in just a few minutes. But this is kind of like the last time you went and ran a search for your own, let's say the last time you bought a car. Well, you had your own checklist of items that you wanted to find. Last time I bought a car, I knew exactly the type of car I was looking for. I knew the kind of mileage I wanted. It was going to be a used car, but I didn't want an abused car. I knew I knew the rough price range. I knew the true characteristics. I had a checklist. I had to screen for these kinds of vehicles. So then I was able to do a quick internet search and find some qualified potential investment candidates, some purchase candidates. However, I'll tell you what I didn't do last time I bought a car. I didn't just run an internet search and find one and then mail a check off to the seller and say, all right, your car qualifies, I'm going to buy it. No, the checklist is helpful in narrowing down the field of tens of thousands of vehicles that I might have wanted to invest in to a few candidates, but once I'd located those, I dove in even further. I actually went and did a test drive, okay? This checklist is kind of like that internet search. It's a quick view just to make sure that we're dealing with something that's probably qualified, but then we're going to take it out for a test, take our candidates out for a test drive. All right, so what are the characteristics? First of all, we have the book value of the company. What is the book value of a company? Well, book value, very roughly speaking, would be if we were to just close the company down, sell off all the assets, including any goodwill that they had accumulated with their audience, their market, that's how much the company's worth. That's its book value, and then you can divide that by the number of shares to come up with a book value per share. Well, if I'm investing in a company, I want to make sure that that book value is uptrending, and I'll show you how to do that in just a minute. But it's a big deal to me. When I'm buying a company, the book value is kind of like the worst case exit plan for a publicly traded company. If they had to liquidate the whole thing, how much would I get back on my shares? That shouldn't ever happen to you. Hopefully it won't if you're looking for good stocks. But we want to make sure that book value is going up. It can be very easily checked. Next up, we have the PS ratio, price to sales. If I'm about to pay $50 for a company, let's say it's $50 per share, and their sales were a measly little 50 cents last year, it's going to take 100 years of revenue just to justify my investment in the company. No way. That price to sales, we want to see that you're paying no more than 3 times last year's sales. So it's a hint that you're not overpaying for the stock. That's a big deal to me. Then we have what's called return on assets, ROA, another ratio that's very commonly used by value investors. Well, what return? Well, what sorts of profits did the company generate over the last 12 months for their shareholders from last year? That's basically the simplified idea of what ROA is, but it tells the correct tale. If I were an investor last year, what kind of a return did you guys earn on my money? Return on shareholder assets. We want to see that that's at least 10% or higher. You can see why all of these things would be so important when you're about to invest in a publicly traded company, especially if it's been beaten up and the markets have been neglecting it. We've got to make sure that it didn't deserve the beating that it took. Then we have the current ratio. Current ratio is a measure of the company's liquidity, but it's called the current ratio because it compares current assets to current liabilities. Think about it this way: if you're running your household budget, let's say that your current assets, in other words, your income for the month is $3,000, but your mortgage is $6,000. We have a problem because your current assets are not able to cover your current liabilities. In that case, if you had a $3,000 income and a $6,000 mortgage, you would have, in that very simplified version of the current ratio, you have a current ratio of 0.5, 3,000 divided by 6,000. We need to flip that around. We want to see a much larger current asset situation compared to current liabilities. We want to see that assets exceed liabilities by at least 1.5, a factor of 1.5 or higher. All right. Then we have PE ratio. It's another price indicator. It's an indication of value. It's just making sure that we're not overpaying for the company, again, overpaying for the stock. We're taking the current stock price, let's say it's again $50. Let's say we're about to pay $50 for a stock, and it had profits of, let's say, $5 last year. Hey, that's not so bad, because if I'm paying $50 and it keeps cranking out $5 per year profits, it may only take me 10 years to get a complete return on my investment in the form of profits. And generally speaking, very broadly speaking, we like to see that ratio somewhere between 6 and 20. In our example, it would have been a ratio of 10. Then finally, we have our price to book ratio. Again, we're referring to the book value of the company. Let's say that if you were to have that fire sale, sell off all the company's assets, shareholders would get a return of $10 per share, and right now the shares are actually trading for $20. That might sound like it's way overpriced. It's actually not, because we're talking about a worst case scenario there. It's probably not going to happen. We just like to see that our price is not more than 3.5 times the book value. So those things, it takes me a little while to describe them, but it's a piece of cake for me to show you how to check these. So I went out, grabbed a stock that's taken a little bit of a beating this year, and I wanted to have a look at these elements and just see if there's a hint there that we might be onto something of value. Let me share my screen. And I'm going to go right to the Analyze tab within the Thinkorswim platform, and I've selected the Fundamentals page. Fundamentals page have all of those ratios that I just referred to, and I want to have a look at a company called Foot Locker. Foot Locker's stock price has come down quite a bit recently. That's why I selected it. And when you bring that up on the Fundamentals page, it gives you a summary of who this company is. But more importantly, most of us know who Foot Locker is. Yeah, they sell sports apparel, you know, T-shirts and hats and shoes and all that kind of stuff. More important than the product is the performance. So I'm going to come down just below the company description, and I'm going to be using these ratios right down here. I'm going to pause right there, and I'm going to bring up a summary of those ratios that we just saw. I have it in my scratch pad right here. So first of all, we're going to look for that book value trend. You'll notice right here, third item down, is something called the book value per share. It's nice to know the current book value, but more importantly, what has it been doing over the last 5 years? And we like to see that it's coming up at least 4 out of 5 years. And as I go through these criteria, let me give you the heads up that it doesn't have to be perfect. If we find something, let's say it meets 5 out of our 6 criteria, that's still a strong indication of value. If they're 4 out of 6, I don't know about that. 3, now we're getting too far from the spirit of things here. But we're 1 for 1. Look at that book value per share. You can see its trend going up. If I scroll up just a little bit, you'll see, and maybe we need to see those title headings. 5-year trend, increasing steadily. That's good to hear, good to see. Next up, we want to see the price to sales. Well, I can see the company's price right here at $47.93. The markets are still open, so that'll change a little bit as we're discussing things. And the sales for last year were actually $57 per share. Look at that. We're paying a lower price per share than the total revenue or sales from last year. That means that our price to sales is under 1. We only need it to be below 3. So check 1, check 2. Now, we want to see that this is a good profitable company. It's earning a good shareholder return on their assets, at least 10% or higher. And you can find that right here. See the ROA? The current year, company has returned 18.65% return on assets. That's fully 80% above what we needed. We only needed 10%. This is at 18. So 3 for 3. Current ratio. Are they able to meet their short-term obligations? We want to make sure that it's at least 1.5 times that the current assets are at least 1.5 times the current liabilities. Foot Locker's current assets are 4.3 times their current liabilities. So we're 4 for 4. PE ratio. Is this a fairly priced company, at least on the surface of it? Is that ratio between 6 and 20? And it is. It's a 9.9. On that topic of the PE ratio, I sometimes get questions. why don't we like even lower PE ratios? You can get too much of a good thing here. You know, conceptually, it might be nice if you found a company that's priced at $10 per share and it had profits of $10 per share last year. The problem there is that's a red flag. Why hasn't the price gone up higher? If the profits are so good, why isn't the price even higher? Well, that's a signal that investors are probably expecting a different performance next year. That's cute that you made $10 last year, but we're expecting maybe your performance to be significantly lower. I don't know, $1 per share, maybe less. When you see a very low PE ratio, it's essentially a vote of no confidence from investors. And whether I understand why or not, that's a red flag. It can cause me to walk away from a stock, okay? And then obviously we don't want it to be above 20, because if you're paying too high of a multiple in price for the profits you're getting on the company, the earnings, you're overpaying. That's an easy concept. Okay. And then finally we have our price to book. We want that to be 3.5. Look at that, it's 3.5. And change, okay, we're doing a little bit of rounding there. But to go 6 for 6 with just one that's maybe a little bit on the edge, that to me is screaming at me, I need to dig deeper. All right. Just come back to our car analogy here for just a moment and think, okay, we've run our internet search basically. We've found 1 or 2 or 3 good cars. You know, they're the right make, they're the right model, they're the right mileage, they're the right price. But how many times have you ever done a search like that and then you show up in real life, you get in the car, you get your hands on the wheel and you realize, wait a minute, the steering wheel is crumbling. And you look around, the car's dirty and the ceiling panel has a cigarette burn in it, and you know, it's just not what you expected. Just because this is displaying the surface characteristics of value does not mean it's still a good deal. How do we determine a good deal? That's done using our spreadsheet. Okay, this spreadsheet is essentially a giant calculator. And I have to explain because there's always a learning curve the first time you ever use what we call the valuation analysis process. It's also known as the capital asset pricing model. It's a mouthful, I realize that. But there's always a learning curve when you first associate yourself with this process, when you're first exposed to it. So maybe I'll just phrase it this way. Let me just say we're looking at XYZ company. And just because I have a crystal ball, I have an inclination that XYZ company is going to be worth $50 5 years from today. Okay, I want to ask you a question. Think this through. How much would you be willing to pay for that company right now if you knew that it was going to be worth, or at least you had an inclination? I'm not going to guarantee that it's going to be worth 50 bucks. I just sense, I think it's going to be worth about $50 in about 5 years. Would you be willing to pay 48 bucks a share? I would guess not. Because that would add up to, what, less than 5% return on your investment total over the course of 5 years? No. I could give my money to the government. I could do the safest thing I could with my money. And I know you're going to say, give your money to the government is the safest thing you can do. Actually, technically, yes. But I could give my money to the government, maybe make 2-point-something% return per year. So I have other alternatives. I got to do better than that. That's the baseline. All right, so would I pay $45? I don't know. We're moving in the right direction now. That still would only work out to be 2 or 3% annually. But about $40. Well, now we're getting in the right range, but some other questions are starting to come to mind. In addition to being able to get a no-risk return on my money of maybe 2 to 2.5%, I don't know what the current number is. We'll check that in just a moment because that's one of the considerations here. I also am starting to think, well, is XYZ kind of a crazy company by nature? Does it bounce around all over the place? If it does, I don't want to pay so much right now. I need a bigger margin. I need a higher return potential. On the other hand, if it's a really stable, consistent performer, and I know it's not going to be this heart-racing roller coaster ride on my way to $50, well, maybe I'd pay a little bit more. I wouldn't need as large a return. This is the logical process that goes, the thought process that goes into this spreadsheet. Because what we're going to do is we're going to take a few steps. We're going to start with a company like Foot Locker, and we're going to analyze it to see how much could we pay for it right now for an expected future value on that stock. And the variables are going to fit what I just described. First of all, we've got to come up with that future value. How do you come up with the future value of a stock? What causes a stock to appreciate? I'll tell you what causes a stock to appreciate. In the short term, it can be news. In the long term, it's that company's performance. It needs to generate profits. So we're going to go have a look at Foot Locker. We're going to see what profits are expected for the next 5 years. Analysts actually give us that guidance that far out. Next, we're going to use that number to calculate our future price, because as profits go, so tend to go price. There's a normal-ish relationship between profits and price. And we call that the PE ratio, price to earnings, or another way you could put that is price to profits. So what we'll do is we look at Foot Locker's historical PE ratio. We look at what the price has been compared to earnings in the past, and we can use that to sort of extrapolate out in the future. Well, if profits grow at a certain clip, we can calculate what the profits should be in year 1, year 2, year 3, year 4, year 5. We can take that year 5 number, and we can do a simple bit of math to figure out, well, what should the price be then? If the company's generating $100 per year in profits in year 5, I don't think the price is going to be $2, in other words. It's going to be higher than that, right? The PE ratio can help us project that. All right, so we're going to calculate that future value. Then we're going to look at how crazy the stock is. We're going to look at how crazy the stock is, and we're going to take a look at how crazy the market is. And that's going to give us a relative feel for how much return we need. And then we're going to look at the current price and see if that future expected value is going to give us the return we need to justify today's investment price. That's it. That's what this spreadsheet does. If you didn't quite follow that logic, that's okay. You'll see it as I go through Foot Locker, and we'll do maybe 1 or 2 other examples. All right, but let's start off right up here. Let's start filling in our spreadsheet, Foot Locker. Okay, so first we need our 5-year forecast earnings. You know, how fast are earnings going to grow? You might think, I don't know where to find that. Well, right over here, it tells you where to find that. You can find that, go to NASDAQ.com, enter Foot Locker in the search box, FL, and then click on Analyst Research in the left column, and then Earnings Growth. So where is that? Let's bring that up here. Okay, in my side screen, I'm just bringing up NASDAQ.com, and then I'll bring that into your view. There it is. All right, so here's NASDAQ.com, and let's type in Foot Locker. You just type in FL, hit enter on your keyboard. If you don't know the symbol, you can just start typing in the name of the company, and that website does a pretty good job of finding the symbol for you. All right, so once the next screen loads, I'm just going to scroll down a bit. And in the left column, I click on Analyst Research. That the step-by-step guide told me to do this. So you can't get lost on this spreadsheet. It just explains every step to you. So I click on Analyst Research. And on this Analyst Research page, I'm going to scroll down again just a shade. And I'm going to click on Earnings Growth, because that's what we need. What are the projections for a growth in earnings over the next 5 years? There we are. So right there, it says long-term 5-year growth. Foot Locker is expected to grow its profits at a 9.91% clip per year for the next 5 years. So you compound that out, and their earnings should grow 80, 90%, something like that, just roughly speaking, over those next 5 years. It might be a little bit different. I didn't actually do the math on that. But I can plug that in to my spreadsheet now. Now that's the one that takes the most digging to go find. And actually, once you get this process started with one stock, It's really easy to navigate to the next stock. You're going to see some time-saving steps here in just a moment. Okay, so next up, I need to find the average PE ratio for Foot Locker over the last 5 years. And again, you think, I don't know where to find that. It tells you right here. Locate and enter the company's 5-year average PE ratio. This is found on the TOS Analyze tab. In that tab, click on Fundamentals. We were just there. And enter the stock symbol. We were just there. Ratio is found in the area titled Valuation. So I go back to Thinkorswim. I go down here. So I'm on that Fundamentals page again. Analyze, Fundamentals, Symbol, and then right down here I go to Valuation, and there's our 5-year average, 14.971. You can put the 1 in there. It's going to round it off for you. So I'll put it in there just so you can see. So if I type in 14.971, I'm not going to break anything by putting in that extra digit, but once I move on to the next field, it rounds that off. It'll round it up or down. Okay, next up we need the stock's beta. Now I said we were going to calculate how crazy this company is. Beta is a crazy scale. It tells you how volatile a company is compared to other companies. Beta is really simple. An average company with average volatility has a beta score of 1. If you're 10% more volatile than normal, you typically have a beta score of about 1.1. In other words, it's 10% higher. If you have a beta of 0.9, that implies that your company is about 10% less volatile than other companies trading on the exchanges. And you can probably visualize why that's important. Because if I'm trying to figure out how much I'm willing to pay for a company right now for expected values in the future, well, I would pay less for crazy stocks, and I would pay more for more stable stocks. In other words, I just don't need as big of a potential for growth on less heart-pounding investments. So our stocks beta, we find that on the TOS Trade tab. I'm not going to read these directions to you. I'll just show you. So skipping over to Thinkorswim, I'm going to go to the Trade tab, and I'm going to type in my symbol, Foot Locker, enter on my keyboard, and here's that familiar quote line. Notice there's a little arrow right here. Click on the arrow, and that reveals our beta, 0.6866. So in other words, I would look at that beta and I'd say, okay, so this company is about 68% as volatile as a normal stock. In other words, it's 32% less volatile. So let's plug that beta in right there. Now we need to measure the market's craziness. And there is a crazy chart. It's called the VIX. It's the volatility index of the S&P 500. Sometimes the S&P is really volatile. Other times it's very stable. Right now the S&P is very stable, but let me show you that. I'm going to go to Thinkorswim again. The instructions are on your screen, but I'm just going to show it to you. I'm going to go to Charts, select the word Charts, and that will take me right to the Thinkorswim Charts tab. And I'm going to use the symbol VIX to bring up that volatility chart, and you can see where we are right now. Those are historic lows. Stocks are historically stable right now. So if you're investing for value, what that means for a value investor is maybe you won't need to have as much of a gap between what you're paying right now and what a company might be worth in the future, because you're kind of stepping into pretty calm waters. It's not, the markets are not as inherently risky as maybe they are at other times. So our current VIX value is 9.58. It says that down here in red, or you can see it right up there. But I'm going to plug that in to this window, 9.58. And then finally, we need something called the ticks. If you recall, I said I could just give my money to the government and get a return, right? That's our baseline. What is, it's called the risk-free rate. What's the government offering if you were to turn your money over to them for a long period of time? How much would they pay you for borrowing their money? That's going to require that we look at the 30-year treasuries. The TYX tells us the 30-year treasury yield. So I'm going to go to the paper money account and type in TYX, and that tells me a current value of 28.37. You might think, wow, the treasuries are paying 28% right now? No, they're not. It actually needs the decimal needs to move one step to the left. You don't need to do that, though. All you have to do is go plug that value, TIC's value, 28.37, into here, and notice you get a line right down here that automatically moves the decimal to the left. So the risk-free rate, if you just skipped this whole process and gave your money to the government for 30 years, you could get 2.837. So we need to get more than that. The question is, how much more? And that depends on current market conditions. In some market conditions, we need a lot more. Other market conditions, we need less. And for some stocks, we need a lot more. And other stocks, we need less. So the baseline, given that we're at very low volatility position on the markets, the baseline is to get at least 5%. If you're talking about an average company, we want at least 5% more than 2.837. But we're not talking about an average company. We're talking about a lower volatility stock than average, so we're going to require less. So we take the stock's beta, multiply it by what we call the market risk premium, and we do have a course if you want to learn more of the details of this. It's called the Fundamental Analysis course. And then we add that to the risk-free rate. And that tells me, Cameron, for Foot Locker, you need to make at least a 6.27% return. In today's market conditions, you're stepping off of a cliff into pretty calm waters. And this is a pretty calm stock. So we don't need, we don't need 15% more than the risk-free rate, but we need more. So how much can I afford to pay on the stock and still make a decent return on that future value that we're calculating? This final line is going to help me with that. I'm going to come right down here and plug in the current stock price. This can be found all over the place, but it's actually right there on the fundamentals page on Thinkorswim. Both of these two are. So I'm going to go back to Thinkorswim, go to that Analyze tab, go to Fundamentals. We already have Foot Locker in here. We can see the price per share is right there, 48.075 on around that 48.08. That penny is not going to make any difference. So let's plug that in. And then finally, we have our stock earnings per share. Okay, I'll tell you why we're getting that in just a moment, but let's go get it first. So I go back here, go to earnings per share, and the company made $4.88 per share. That was last year, 4.88. All right, so I have now entered all the variables I need. This little box here that says 5-year adjustment, you don't need to do that. Don't put anything in there. But what we just did is I just told the system, hey, here's a company that made 4.88% per year last year. The analysts are expecting that that earnings performance to grow at a 9.9% clip per year for the next 5 years. The system automatically takes that. They calculate out 5 years to tell us what the earnings are going to be in the 5th year. They multiply that. I know this is a bit to follow. The Fundamental Analysis course will show you the particulars of this if you want to do that. But it calculates out that future expected price of the stock based on earnings, or it actually first calculates the earnings themselves for year 5. It multiplies that by historical PE ratio, and that gives us that future expected stock price. And then we can work back from that. If we know the future stock price, we can figure out what's the most I can pay today and still get a 6% or 6.27% return if we hit that future expected stock price. And that amount, the most that we could afford to pay right now is $76. If we bought this for $76 and profits kept growing for the next 5 years and the normal relationship of price to earnings maintained, we should get about a 6.3% return. Well, guess what? Here's the good news. I don't have to pay $76. The stock is trading right now at $48. It's a discount from that calculated maximum that we could pay. And that discount is what we call our margin of safety. Why do we call it the margin of safety? Well, because we're dealing with theoretical numbers here. Is there a possibility that the analysts might be wrong with their projections? There is a possibility. Believe it or not, analysts are pretty good at their jobs, though. They're pretty good. It's not like forecasting the weather. If you look at a company's earnings performance versus analyst projections, you'll see those are usually pretty close together. That's why the markets react so violently when they're off by even a penny. So that number, it's not that I just think that's a pie-in-the-sky number. I think that carries a lot of weight. And at the very least, at least the analysts are expecting growth. That's a good thing to be able to say about a company that you're about to invest in. Okay, now we can use that growth and that calculation to multiply it by the PE ratio, figure out that future price. Well, the average PE ratio for the company has been around 15. Actually, that's about normal. In most market conditions for most industries, a PE ratio of 15 is pretty normal. Those ratios can get a little out of whack at times, though. So the system automatically adjusts for the possibility that, yeah, the earnings forecast might be a little bit wrong. Yes, the PE ratio might be a little bit, let's say, optimistic. And if you really want to get in the nitty-gritty of that, you can look right down below, and it'll tell you how much it's going to reduce those things, right down there. It'll also tell you where this 5 came from, the market risk premium. There's a table right there that will tell you that. But I'm not going to go too far into that because it's covered in the fundamental analysis course. But class, here's what we've just accomplished. And it's been a bit of a mouthful, but we'll do it again quickly on another stock. We just looked at Foot Locker. We saw that if you looked at its chart, you would have noticed that it was in a downtrend. Does it deserve to be down there, or is it a good value? And then once we ran the numbers, we determined, yeah, this stock is very likely underpriced at this point. The analysts are expecting it had good profits. All right, so let's find something else that's similar to that. Well, let's do this. Let's have a look at Urban Outfitters, okay? Let's go back to, this is just what you would do. If you have a company and you just want to check the pricing of it to see if it's a good deal or not right now, see if it's maybe potentially undervalued, first take a look at it on this fundamentals page. And you have your checklist here. You might want to jot it down just like I have. You can commit it to memory, but we want to see that the book value per share trend is up. Notice this one's kind of up and down. It's been up over the last 12 months. That's nice. That's what this spike is. But it actually had a down slope right there. So we didn't meet the criteria here. The rest of them, though, I believe, if memory serves me correctly, Urban Outfitters is looking pretty good. Price to sales? Well, the price is 18 bucks. Sales are 30. Yeah, its price to sales is like 0.6. Return on assets? 12.36. We only need that to be at 10. So we got that. Current ratio? We need current assets are 1.5 times higher than current liabilities. They're 2.5 times higher. PE ratio? Yep, between 6 and 20, leaning a little bit more towards 6, which is great. Strong indication of value. And price to book, it's a 2. We just need it to be a 3.5 or lower. So this one passes, let's say, the eye test. Now let's run the numbers. So you think, oh, got to run the numbers. That took so long the last time. Let's see how quickly we can do it. Because once you've filled this in, I don't need to go check things like the VIX value again or the TIC value. Those didn't change. Those are universal to all the stocks that you're going to analyze. We do need to see the 5-year forecast earnings growth, but I'm already on NASDAQ.com. All I need to do is type in URBN, and since I'm already on that earnings growth page, I just need to type in the new symbol and click on earnings growth again. And that'll give me my 5-year projection. The only thing slowing us down right now is the browser. There we go. It's not that this is complicated or it's taken us a long time. No, a little browser slowness. There we go. So 14% projected earnings growth. So let's plug that in here. You can put it 14.00 or just 14. That's fine. Okay, I'm going to give you a little time saver here. Notice that the 5-year average PE ratio and the stock earnings per share and the stock price are all on the same page. So really, to fill out the rest of this, we only needed one page here one page between these three, and then a page there. So let's go to our paper money account. We're already on the page that we need. There's our price, $18.18, so we can plug that in right there. We already have our earnings per share. It's $1.71, so I can plug that in. And we already have our 5-year average PE ratio. It's going to be right here, 18.433. You can type in that last 3 if you want to. It's just going to round it off. So it's 18.43. There we go. And then the last thing I need is the stock's beta. If you recall, that's on the trade tab. You type in your symbol, and you get it from the second line down below that last price. It's over here. It's 0.6334. That's it. You've completed your calculation. Let's see. Here's your big reveal. Wow. All right. So Urban Outfitters is trading right now at $18. Think about this. It's trading at $18. It had $1.71 in earnings last year. All the analysts that follow this company are expecting earnings to grow at 14% per year for the next 5 years. That means that its earnings, boy, what's that going to be 5 years from now? It's going to be like I don't know, $4 a share, and I'm only paying $18 per share right now. Okay. And of course, if earnings grow faster, returns are even higher. If they're slower, we know the impact of that as well. Class, that is the process. Jot down those 6 ratios and get acquainted with this spreadsheet, and I think it's going to add some value to your portfolio review process. I really do. All right. Class, let's take us back. It's been such my pleasure to take you through this. Okay. I do want to give you a quick reminder. I think this is a great comment here. Risk is not inherent in an investment. This is another value investor, another hedge fund manager. Risk is not inherent in an investment. It's always relative to the price you paid. If you overpay, class, you got a lot of risk. On the other hand, if you can find a great company at a very low price, you are hedging that risk. Uncertainty is not the same as risk. Indeed, when great uncertainty, such as the fall of 2008, drives securities prices to especially low levels, they often become less risky investments. It's easy to see now in hindsight. It wasn't so easy to see back there in 2008. So we just have to remember, when you're doing your value investing, you're beginning with the end in mind. Have your checklist, have your process for taking your stocks out for a test drive, really determining their value. Today, we now understand how value opportunities can swing back and forth between industries. And those industries, the examples that we provided are not exclusive for where value opportunities can be found, but a good discussion. We saw how the opportunities can swing back and forth between staples and cyclicals. We've identified the characteristics of value stocks. We've used those as a filter to screen out thousands of others that aren't candidates. And then we learned how to estimate a stock's intrinsic value, meaning how much is the most I could pay for it right now for that future expected price. And we use the valuation analysis Excel spreadsheet to get that accomplished. All right, class, so it's time for you to apply what you've learned. I'd like you, while it's fresh, grab that spreadsheet and practice finding value opportunities. The values can be from anywhere. Just think about what's out of favor right now and go start digging through companies in that industry. It might be cyclicals, it might be staples, it might be gold, it might be who knows what. Use the valuation analysis spreadsheet. Do it on paper first. We're not diving into the deep end of the pool here. That's why we have a tiny little swimmer there. That looks dramatic. That pool's probably 3 feet deep there. Start at the shallow end, get your paper money out, use your spreadsheet, and get some repetition with that. And if you'd like to see the details of some of the things where I just didn't have time to cover those details in this discussion today. You can take that fundamental analysis course. It will show you how to do the valuation process, again, step by step. It also gets deep into growth investing. So it has definitely been my pleasure to bring this to you. If you'd like to see me in some of my other classes, I have trading rooms every week on stock investing. I have online coaching for stock investing, technical analysis, option strategies. I hope to see you in one of those formats or in another live discussion, but whenever I see you again, until that moment arrives, good luck and happy investing. Bye-bye.